And so we've calculated that for each unit of output, we're going to apply $4.50 of depreciation expense for this piece of equipment. Now when I apply the units of activity method, I set up a series of 4 columns. We're going to have a column for the number of units produced, and this is going to be actual output that will be given to you. We have a column for our depreciation cost per unit, which we just calculated. Multiplying those two together, and we'll have a column for our current period depreciation expense, and we'll also set up a column for our ending book value. Now based on our calculation, we know that our depreciation cost per unit is going to be $4.50. And so we can apply that uniformly across all years. And we can also fill in our units produced based on the given output as part of the problem. And so we know that in each of the first 2 years, 5,000 units were produced. We have production of 4,000 units in year 3. We have production of 3,500 units in year 4. And we have production of 3,000 units in each of years 5 and 6. And so what we can do here is just multiply across to calculate current period depreciation expense. So first off, we take 5,000 and multiply it times 4.5, and we get current period depreciation expense of $22,500, meaning that our ending book value is $77,500. We're going to get the same numbers for year 2 because our production was the same, and that brings our ending book value down to $55,000. We're going to do some math for year 3, calculate depreciation expense is $18,000, meaning that our ending book value is $37,000. In year 4, our calculation is that depreciation expense is $15,750 for an ending book value of $21,250. In year 5, a similar calculation gets us to a current period depreciation expense of $9,000, and our ending book value is $12,250. Now once again, we have to be careful with this salvage value, and we see that we're getting pretty close to the salvage value, and so that at the end of year 6, our ending book value needs to be $10,000, and so even though our calculation would give us depreciation expense of $9,000, we can only depreciate $2,250 because that's what brings us down to our salvage value. Okay. And so if we want to do a quick comparison across the different depreciation methods, I'm actually just going to fill this in based on what we had in the calculations above. And so straight line obviously applies the same amount every year, and the double declining balance method applies high amounts of depreciation expense in early years and less depreciation expense in later years. And so what we see is that based on that fact, we see that income is actually going to be higher in year 1 under the straight line method, but income is going to be higher under the double declining balance method in year 6. And so this is actually because, of course, we're depreciating the same amount over the life of the asset. It's just a difference of timing. So our timing is such that we depreciate large amounts in early years under double declining balance, but because we have the same depreciable base, that's going to necessitate that we have less depreciation in later years. And so the last thing we've got is how to deal with the sale of long-term assets. And so in this case, we need to know the purchase price, the amount depreciated to date, the book value, and the proceeds of the sale. Now note that the difference between the proceeds of the sale and the book value tells us if there is what's called a gain or a loss. And so we're going to end up finishing up this calculation in the next file. So we're going to finish things up by showing how to account for the sale of long-term assets. And so in our example, we need to carry forward some information from Part 1C. And the situation is that Flanders decided to sell this piece of equipment after 4 years. And so what we need to do is know, first off, how much has been depreciated to date. Now from part 1C, we know that our straight line depreciation has us calculating depreciation expense at a rate of $15,000 per year. And so at the end of 4 years, we're going to have depreciated a total of $60,000. And so our original purchase price was $100,000. And so if we subtract out $60,000 that has been depreciated to date, we have a current period book value of $40,000. So we have this asset carried on our books at $40,000. So when we sell this asset for $15,000, we can subtract out that book value, and what we see is that we're going to have a loss of $25,000 because we're getting a lot less for this asset than we currently have it carried on our books. And so if this was opposite, where we were selling the asset for more than our current book value, then we would get a gain. So in this case we have a loss, and so what we're going to end up doing is producing a journal entry with 4 accounts affected. So first off, you're going to always have a debit to cash, and your debit to cash is going to be listed at your proceeds. And so since we sold this asset for $15,000, we're going to have a debit to cash for $15,000. Now the next 2 entries are designed to pull this particular asset completely off our books. Right now we have equipment of $100,000 still on our balance sheet, and so it has a current debit balance, and so we're going to need to credit this equipment for $100,000 to completely pull this off of our books. And we also currently have accumulated depreciation of $60,000 that has been depreciated to date. We need to pull that off as well. That currently has a credit balance, and so we're going to have to debit accumulated depreciation for $60,000. And so these 2 line items completely remove the asset off of our books, and then we have to account for our gain or loss. And in this case, since we had a loss on the sale of equipment of $25,000, we're going to have to debit this loss account for $25,000 to recognize the fact that we sold this asset for significantly less than we have it carried for on our books. And so note that losses, even though they're not explicitly expenses, behave like them, so they have debit balances, whereas gains, although they're not explicitly like income, have a normal credit balance. So hopefully this clears up some of the major issues related to the problems for Chapter 9.